You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, it's Jonathan Rose. Welcome to another edition, Masters in Trading Live. We get on here every day. The market's open, 11 o'clock Eastern Time. Go over the market, share our thoughts. Once in a while, we'll even share our trade of the day. Hope you guys are okay. SMCI, free falling. Free falling. From a high of 1,200, last trade 400. Be very, very careful with SMCI. This just might be the next Enron. Lots of problems with SMCI. I want you to stay far away from that stock. But SMCI does remind me of what I think is the greatest nickname of all time. Back when I was in college, I went to University of Miami, Miami Hurricanes, the U. You know, boys will be boys. One of our friends was just one of these guys who, no matter what happened, Miami could just win the national championship and he'd say, oh, they played bad, or oh, it was a bad game. He's the most negative person. Everybody loved him, very sweet kid, but he was just one of these kids that anything happened, he would always see the negative side of everything. So therefore, he earned what I think to this day is still the greatest nickname ever to give somebody in college. We called him Enron. Because every time my friend Mike walked into the room, he stole all the energy. So Mike was called Enron. Let's get to the 4 topics today. The 4 topics are why. You want to buy XYZ? Why? You want to buy calls? You want to buy puts? Why? Have a reason. Technical analysis is not a reason to be in a trade. Feel, it's not real. Have a reason. So we're going to go over why. We always talk, well, not we always talk. A lot of traders talk about these 2 times, 3 times, 4 times leverage products. They are absolute garbage. Don't touch them. I'm going to show you why. We're going to talk about time decay, and then we're going to talk about gamma. You guys are going to like this one. Let's head over to the slide deck. Okay. Let's have some fun, guys. Got you at the slide deck. This question was in our Discord yesterday. James, really great question. I'm not sharing this to embarrass in any way. I'm just sharing it because it's a really good learning lesson. So yesterday I talked about a trade. We got to work on JR's penmanship in TLT versus the IEF. And so the comment was, what about TMF against the IEF? Whenever we talk about trades, there needs to be why. 3 times leverage. Okay, that's the reason. Did you know that 3-time leverage products have time decay? Equal supply and demand for a stock, the stock would move like this. Equal supply and demand, right? Buyers and sellers. But if there's equal supply and demand for a leverage product, it's going down because there's decay. Okay? You need to realize that if you're going to risk money in these products. So let me explain. Time decay and options. Okay? Options have time decay, right? The time decay component of an options price that erodes its value over time. As your expiration gets closer, your theta, the time, is accelerating out of your position. How do we fight time decay? Well, we can spread, we can roll our options into the next month, or we can do something called gamma scalping. Did you know that theta is time, right? The opposite of theta, that's not really an opposite side, is gamma. Theta and gamma are just opposites. So let me explain. Time decay with lots of time until expiration here It's going to be slow. So if you want to pick in December expiration, you're not going to decay so much. If you pick an expiration that's 2 weeks away, you are going to decay like it's nobody's business. Short time until expiration. Let's say you get into options with 12 days to go until expiration. You got to be right because that premium is going to be sucked out of your options. So understand that if you go out to December with your options and you have 80 days, you're not going to decay so quickly until those final 20 days. If you go into short-term options, you got to be super smart and super clever because that time is going to erode quickly. Now, let's talk about hidden time decay. Hidden time decay is no bueno because at least with options, we know that there's time decay, right? What we don't want is to be in a product with equal supply and demand that decays over time. You need, unless you're aware of it. And products like leveraged options have decay. Okay? High volatility can exacerbate the decay, but because many of these products have daily rebalancing, there is going to be decay. And as traders, not knowing about this decay is why we say education mitigates risk. Okay? I don't need to write this out, but hi, buddy. How are you? He's so cute. Moving on. Now I'm going to show you a couple of examples. TQQQQ is the leverage product against the Qs, right? The Qs are up 326% over 5 years. TQQ, excuse me, Qs are up 150%. TQQs are up 326%, up 2 times when this product is actually 3 times. Here's another one. NUGT against GDX. These are leveraged. So therefore, over time, they're going down. They are not equals. You cannot trade one against the other. Leverage products, really, you should never, never, never buy calls. You should only consider buying puts. And finally, an example in the UVXY, UVXY against the VIX. Over the last year, the VIX 13%. UVXY is down 35% because of daily rebalancing. Okay? I don't like leverage products. I don't understand why you would want to use leverage products. Instead, if you want to trade 3 times leverage, just trade 3 times bigger on the regular product. Don't put yourself into this artificial nonsense, please. Gamma. Gamma is the opposite of theta. Okay, let's get my Mr. Pen. There we go. Okay, gamma is the opposite of theta. While theta erodes value over time, gamma represents the rate of change in delta, and this provides the potential to offset time decay. Many traders understand theta, but find gamma confusing. You shouldn't because they're just opposites. And then skilled option traders use gamma scalping to recapture lost value. So right now, I'm going to give you an example on gamma scalping. Gamma scalping. So here we go. Let's say we buy the 6 strike for 50 cents. And let's buy that 10 times. Okay? That says 10 times. Right here, I'm going to do our position right here. Okay? We are long 6 strike calls, right? $500 of risk. Now, long six strike calls, when you're in the money, is the equivalent to being long 1,000 shares at expiration. So if we expired at 12 and you're long the 6 strike calls, you make 6 minus 50 cents or $5.50. If we expired at 12, you would risk 500 and make 5,500. Let me show you what you can do. Buy 6 strike for 50 cents, $500 of risk, okay? When the market goes up, do you realize that you could sell up to 1,000 shares of the underlying stock? Let's sell 300. If we sell 300, remember, we're long 1,000 once we're in the money, right? So now we sold 300. Our position is still long 6 calls and short 300 shares. Now, synthetically, these were only long 700. We're still long 6 calls. We don't touch these, okay? Pretend you're in a fancy store. Do not touch. Because all we're going to do is trade now, okay? We go back down, buy 300 back, okay? Now we're scalping gamma. We just make 8 minus 2. We just make $1,800 on this little trade. You never touched your options. Now your options down here, oh no, they're worth 0. Who cares? Because you just locked in money. Hey, the stock goes back up. Let's sell 500 shares because we're long 1,000, right? Short 300. You buy back your 300. We're in the money again. So great. Let's sell 500. It comes off. You can buy those back. You could sell more. Okay? Don't touch your options. Your options are long 1,000 shares only when they're in the money. So what am I doing here? I am selling shares before expiration. At expiration, as long as you're flat stock, if you held your options, if you're out of the money, those expire worthless. If they're in the money, you can cover your stock. This is super, super important. And many traders have no idea that you can use this kind of trading to finance your long options. I would also say that when traders come into our Discord community and they start learning this, there's a little bit of a learning curve. But once that light bulb switches and they're like, oh, I get it now. I had no idea that you could manage your options position using stock. And then traders get to see, wow, options are just stock. They're just a derivative of stock. There's no big difference. Once you start learning that and seeing the difference, that's when I notice that people have really big breakthroughs. Before I leave, I want you to think about this. Many of you trade options not knowing that you can use stock to manage your options position. Now that you've learned this lesson, what's the downside of not knowing this? Quite a bit, right? Because think about all those opportunities that you have in your options position that you just don't know. That's why we say education mitigates risk. The most difficult thing that I believe in options trading or investing is learning, stop making stupid mistakes that just cost money. Learn. The more you learn, the more you can earn. Education mitigates risk. In our all access portion, we have 2 earnings names that came out. We're going to go over those earnings trades. Thanks so much for watching. If you guys have any questions in the YouTube video, those comments, please leave any questions, send a note, to us, we'll try to help. Thanks for watching, guys.